dear students. I hope you are all doing good and I welcome you all to the 20th video lecturing session on financial markets and services. This is a subject which is kept for the final year BBA students of Bangalore North University and Bangalore University as well. The chapter that we are discussing is non-banking financial intermediaries. That is second chapter of this particular subject. The content for this session's discussion is venture capital fund, its meaning, characteristics and its advantages. So this is what we are going to discuss in another 30 to 35 minutes. Moving further, we have a recap of the previous class. In our previous class, we had discussed about housing finance, its meaning, types of housing finances, assistances, and the institutions that provide housing finance assistance in the Indian context. We had discussed brief about this concept. So you can go back to the video, review it and you can memorize it. Next we have learning objective of this chapter. As I have told you previously, it is same for all the sessions which come under second chapter. Next we have session outcome. So it is different for every session. So by the end of this particular session, you should be able to define venture capital and venture capital company, and you should also be able to explain the characteristics of venture capital, and you should also be able to state the advantages of venture capital. So this is the session outcome that has been framed. So moving ahead, we have venture capital. So let us understand what exactly venture capital is. So venture capital is a long-term risky capital, I can say it as. It is risk or risky capital to finance high technology projects which involves risk. Then what is risk? Risk is something uncertainty, possibility of not getting profit or not coming out with success, or possibility of getting into losses. So this we call it as risk, the context of risk. So it is a long-term risky capital for what? To finance high technology projects which may not be able to finance by a single entity or person. So which involves risk, but at the same time, where there is more risk, there is also a potential for the high returns or yields. So that is what it is said here. At the same time, it has strong potential for return and growth. So when a person or an entity is ready to take up more risk, he is also correspondingly given with more return and growth opportunity. So this is the principle of investment. Where there is more risk, there will be more opportunity, or we can say there is more potential for the return and growth. Moving ahead, we have venture capital company. So what is it? A venture capital company is defined as a financing institution or institutions which joins an entrepreneur as a co-promoter. ಅಂತಂದರೆ ಆಲ್ರೆಡಿ ಒಂದು ಎಂಟಿಟಿ ಇರುತ್ತೆ ಅಥವಾ ಇಲ್ಲದೇನೂ ಇರಬಹುದು. ಆ ಎಂಟಿಟಿ ಇನ್ನೊಂದು ಎಂಟಿಟಿ ಜೊತೆ ಅಥವಾ ಇನ್ನೊಂದು 3-4 ಎಂಟಿಟಿಗಳ ಜೊತೆ, ಎಂಟಿಟಿ ಇನ್ ದ ಸೆನ್ಸ್ ದೇ ಆರ್ ಆಲ್ಸೋ ಸಪ್ರೇಟ್ enterprises. So all these 3 to 4 enterprises come together and they form a new enterprise. Okay, so each of them will be considered as co-promoters in a project, and they share the risk and rewards of the enterprises. Okay, it is as simple as partnership firm, but here the enterprises are going to be partners, they individuals are going to be partners, and the governing guidelines are different in case of partnership firm and in case of venture capital and joint ventures. So next we have characteristics of venture capital. We will look into it one by one. So the very first characteristic or feature of venture capital is risky projects. So what does it mean exactly? So as the venture capital funds are channelized towards new startups, there is also a scope for the failure, or we can say ups and downs during the success path of the company, which poses a great uncertainty of risk on the investors in venture capital fund. ಈ ರಿಸ್ಕ್ ಅನ್ನೋದೇ ಅನ್ಸರ್ಟನಿಟಿ ಅನ್ನೋದನ್ನ ಡಿನೋಟ್ ಮಾಡೋದಕ್ಕೆ ಇಲ್ಲಿ ರಿಸ್ಕ್ ಅಂತ ಹೇಳ್ತೀವಿ. ಬೇರೆ ಏನು ರಿಸ್ಕು ಇರೋದಿಲ್ಲ ಇಲ್ಲಿ. ಸೊ ಇದೇನು ತಲೆ ಬಿಸಿ ಅದೆಲ್ಲ ಸೈಡಿಗಿರುತ್ತೆ. ಸೊ ಇಲ್ಲಿ ಮೇನ್ಲಿ the background or the context in which we use the word risk is it is the uncertainty, because the startups are coming into the market, coming into the industry at the very first time, and there are highly technology oriented projects, and certain sometimes there will be small and medium enterprises also. So the success rate is futuristic in nature. So futuristic cannot be measured. So in this background, the venture capital investment is risky, and it is always, the venture capital always focuses on risky projects. The next point we have is early stage finance. So venture capital is more prone for the promotion of newly establishing companies. Hence it is early stage of financing. ಆಲ್ರೆಡಿ ಎಸ್ಟಾಬ್ಲಿಷ್ ಆಗಿರುವಂಥ ಒಂದು ಕಂಪ್ನಿಗಳಲ್ಲಿ ಹೋಗಿ ಇದೇನು ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಮಾಡೋದಕ್ಕೆ ಹೋಗೋದಿಲ್ಲ ಯಾರು ವೆಂಚರ್ ಕ್ಯಾಪಿಟಲಲ್ಲಿ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಮಾಡ್ತಾರೋ ಅವರು. ಸೊ ದೇ ಮೇನ್ಲಿ ಫೋಕಸ್, ಆಸ್ ವಿ ಹ್ಯಾವ್ ಆಲ್ರೆಡಿ ಡಿಸ್ಕಸ್ಡ್ ಇನ್ ದ ವೆರಿ ಫಸ್ಟ್ ಪಾಯಿಂಟ್ ಆಲ್ಸೋ, ದೇ ಮೇನ್ಲಿ ಫೋಕಸ್ ಆನ್ ದ ವೆರಿ ಸ್ಟಾರ್ಟಪ್ companies. So these venture capitalists cater to the early stage financing. This is what it means. So next characteristic we have is illiquidity. So what does it mean exactly? It means once the venture capitalists invest in the venture capital fund or in a joint venture project, their investment cannot be converted into cash quickly if they require. So it means to say early liquidity by cashing out the short term is not an option for venture capital funding. The only way that is available to cash it up is by way of disinvestment. Disinvestment is giving up the stake held by a person or entity in a huge or in a bigger volume to number of investors by way of dividing it into shares. This is what exactly the disinvestment is. So it is nothing but whenever the capital is held with a single person or with a very few persons, they divide their capital, their stake into number of units by way into shares or debentures. Or debentures is very less, preference shares, equity shares, like that they divide it into number of parts and they will issue it to the public or whoever is interested to invest in it. So that is the only way available for liquidating their capital. So but in venture capital option, the liquidity is very less compared to other financing methods or other investment portfolios. The next feature we have is long-term commitment. Venture capital funds need to be locked or latched in the project for a period of few years before the disinvestments. That is what, unless the venture capitalists disinvest, go for the divestment, their funds cannot be taken back. So it is locked for a period, for more period, or locked for a few years until it is disinvested. The next point we have is partnering. So what is it? Venture capital funds are pooled or partnered by few institutions who share and bear profits and losses either equally or upon an agreed ratio. So there will be an ratio agreed, mutually agreed ratio amongst the partners or investing organizations in which they have to share their profits or even losses. So accordingly they share. So this is what the partnering mean. Next point we have is form of financing. So venture capital is also a form of financing new startups, just like going into the primary market and issuing the shares and debentures. Uh, and this kind of venture capital financing is more suitable for new startups, wherein it is technologically and you know innovative project which involves either marketing techniques or technological know-how or the huge investment component or the manpower. So whoever is sharing in all of these aspects, they come together and they get into a joint venture by putting their joint capital or venture capital. Next point we have is participation in management. In addition to providing capital, venture capitalists take an active interest in the management of the assisted firms in whatever the whichever the firms, whichever the joint ventures they have put in their venture capital. Thus, the approach of venture capital firm is different from that of the traditional lender of banker. If the bankers lend the finance, they just expect interest and their principal, but they do not participate in the management of the company. But in case of venture capitalists, they do participate in the management of the company. They become the interested stake and shareholders. Next, we have advantages of venture capital. We have some listed 5 advantages. The advantages of venture capital go like this. The very first advantage is it's a long-term finance. It caters to the, or we can say it caters to the long-term financial requirements. How does it cater? Venture capital investors know the fact that their funds are going to be locked for a long term and no early returns are expected. Knowingly they invest, so this caters to the long-term financial requirements of the projects or the companies. The next advantage we have is business partner. Venture capital investors just do not become lenders and keep quiet. We have discussed the same point even in the features also. They become business partners. They shoulder the burdens of the business. This is how they become the business partners. Next we have is additional funding. So venture capital is initial funding or initiation funding. If the company requires additional funding, they can also bring in additional funding in the later stage through different ways, either by disinvestment or by extending the capital outlay requirement. So the in this background, the venture capital option will cater or will serve as an additional funding opportunity or option. Next we have is favorable impact on economy. Money, we have three components of production. Three M's, we can say it as three M's: men, money, material, out of which money plays an important role. So money is one of the most important factors of production in any economy. Many startups and small companies try and walk away from the industry without initial capital. So in this background, venture capital fund acts favorably for the development of the economy and industry as it focuses more on new startups. on technology oriented high technocrate projects. And the next advantage we have is no obligation for repayment. How is it? There is no obligation to repay the venture capitalists investors if the startup fails or shuts down. Why? Because the venture capitalists themselves are the promoters of the company. So when the company fails, they're not bound to anybody uh, to repay the debt because they themselves are the owners so far. If the company moves further, then they can disinvest. Then they can issue the shares and all. So as long as the venture capitalists only persist in the picture, they only bear the losses. They are the only the stakeholders. Even if there is huge profit, they only enjoy it. Even if there is huge loss, they only suffer it. So other than that, there is no debt on the part of the company, uh, be it a third party or any other lenders. And we have arrived at multiple choice questions. The first question we have is, which of the following give finance to young startup companies? Options we have is, so venture capital firm, finance company, small business finance company, capital creation company. The right answer is venture capital firm. The next question, what is the full form of VCT? We have four options. We'll look into the right option, right answer. So it is venture capital trusts. VCT stands for venture capital trusts. The third question is, VCTs invest in which of the following assets? So any new startup companies, companies listed in stock exchanges, companies listed on AIM, none of the above. The right answer is companies listed on AIM. Then what is AIM? AIM stands for Alternative Investment Market. The fourth question we have is, which of the following clearly defines venture capital? So we have four options. We will go to the right. So it is long-term startup capital provided to new entrepreneurs. So this is the clear-cut definition of the venture capital. The next question we have is, the need for venture capital financing was highlighted by which of the following committee in India? The options we have is Bhatt Committee, Gadgil Committee, Urjit Patel Committee, none of the above. We'll see the right answer. That is Bhatt Committee. So Bhatt committee was the one which recommended the necessity and introduction of the venture capital financing in India. So usually, if any new thing has to be brought in to the system, a committee will be formed and a head will be appointed. So in a similar manner, uh, for the matter concerned to the venture capital financing, so Bhatt committee was constituted, and Mr. Bhatt was made as the head of the committee. So we have come at this reference stage. So these are the textbooks which are referred for the preparation of this content and for the understanding of the concepts. Even you can go through these textbooks. Thank you.